Let's start with chapter 7. Chapter 7 is about recording monies received. Now, in the last chapter, we have seen that whenever we are receiving money, so how we can bank that money or how we can deposit that money into our bank account. Now, in this chapter, we will see that whenever we are receiving money, so how we have to make sure to record that money. And obviously, to record that money, we need to consider the day books. Some businesses, along with the day books, they also maintain remittance list and cash register. It's better to say or cash register. Okay, any one of these two. And along with day books, then we have to make journal entries as well. Where? In our ledger. And then after ledger, the rest is simple. You have already seen in the completion of the accounting cycle that after posting entries in the ledger cash account, we will close it down at the end of the year. Then we will take it to the trial balance and we prepare financial statements, and this cash balance or bank balance will report as a current asset in the balance sheet. All right. Now the topic list. First, control over recording receipts, that we already have seen in the previous chapter. A little bit we will talk more about that. Then what are cash registers and why we use cash registers? Received sheets or remittance list. What are these and why we produce them? And posting cash receipts to the journal ledger, obviously in the cash T account. That we already have seen in the accounting cycle. A little bit more we will discuss in detail. Okay, control over transactions. First of all, segregation of duties. Here consider an example that we are running a business and we are having Mr. A. Mr. A is our cashier. So Mr. A, the cashier, he is on the cash counter and he receives cash from our account receivables as well as from our cash customers. Over the counter he receives cash. Then at the end of the day he counts the cash and then he records the cash. And in the next morning when he arrives at office, then he deposit or bank the cash. Now all of these transactions, basically in this transaction, there's a cashier. And how many steps are involved here? Collection of cash, counting of cash, recording of cash, and banking the cash. So basically he is completing the cash transaction in 4 steps. Now what is the problem in this? The problem is that cashier has an absolute authority. He is having absolute authority to record cash transaction. He can collect cash, he can count cash, he can record cash, and he can even deposit or in the bank. Now the problem is that if one person is responsible to complete whole set of transactions, then there will be a huge chance or maximum risk of fraud. Because if, for example, he is collecting 1,000, but after receiving $1,000, he count it as 900, he record it at 800, and he only bank it 700. So out of $1,000, every step he lost some money, or he fraud some money, or maybe he is not a dishonest person, but he's an honest person and he made some errors in recording these transactions or processing these transactions. So there can be a fraud and there can be errors. So what is the best way to do that? First of all, cashier should be responsible on the cash counter to collect the cash. Alright, then at the end of the day, he can count the cash, and after that, he should prepare a, let's say, remittance list, and then there should be an accountant in the business or any senior person in the business. He should come over and he should compare the remittance list with the actual money received. Then once he record the transaction in the day book or in the ledger, then this accountant should also authorize this transaction. And whenever he deposit this amount in the bank, then whatever are the pay-in slips, he should share those slips with the accountant, and accountant should review this. Now what happened? Basically, the same cash processing cycle is divided between two people. And when the same cycle is divided between two people, there will be very less chance of fraud or errors. This is what we call segregation of duties. Dividing one operating cycle or one procedure or one process between multiple positions in the office or multiple people in the office. Second, bank reconciliation. Now, first we have cash book. And second, when we deposit money, when we receive cash for the first time, we record it in the cash book. After that, then we deposit it in the bank, and at the end of the month, bank will give us statement of our account, which we call bank statement. Now, bank reconciliation basically shows that if you have recorded $5,000 on 1st January 2022, then you need to compare it, you need to find it on the bank statement as well. Maybe on bank statement, bank will actually give you deposit on 3rd January 2022 for the same $5,000. So you need to cross-check your cash book against the bank statement. This is what we call bank reconciliation. In chapter number 11, we will be talking about bank reconciliation in more detail. And of course, bank reconciliation is the most important topic for the FA1 examination. All right. After this, cash book. Now, cash book is what basically this is our day book. But sometimes it becomes very difficult for us that maybe we have huge volume of transactions, huge volume of cash transactions on a daily basis, and we do not get that much time that individually all these transactions we should record it in the cash book. So what is the best way? One way is to make a remittance list. For example, these remittance lists are basically on a daily basis. So for 1st January 2022, this is the day. So whenever cashier receive cash, for example, from A we receive $100, from B we receive $200, from cash sale we receive $300, and total we receive $600. Then at the end of the day, he will take this list and he will actually compare it with the cash in the till. So if it's confirmed that he is actually holding $600 and the same amount appears on the remittance list, then he will post the summary to the cash book or day book. So in the cash book, what he will going to record for 1st January 2022, the total cash receipt is $600. That's it. He will not going to bring all these individual transactions in the cash book again. There's no need for that. Same, we can also use cash register as well. We will keep the cash register over the counter, exactly like remittance list. Remittance list is basically a sheet of paper. Cash register basically is the same sheet but in the register. And in the cash register, first we will record all the individual transactions throughout the day or maybe throughout the week, or at the end, and then at the end of the day or at the end of the week, then we will summarize the amount and then we will post it in the day book. So this will just cash register or remittance list. By using this, it will just improve the practicality of the accounting for cash. So just to improve the practicality on a daily basis, we use cash register or maybe remittance list. But this is not compulsory one. But obviously this is the most practical one.